Oh, there we go.
All good?
All good.
Okay. First thing first, I want to introduce myself. My name is Monte. I'm 20 years old. I've been investing, learned about investing since I was about 17 years old. I went to school to be, I was a finance major, went to Maryville University. Um, I took CAPS course for a long term when I turned 18. I bought that for myself, and then ever since I just, been kind of learning and stuff like that, taking off. So I'm kind of 3 years in with my experience and learning, but I really took, the new age approach since I'm so young to charting. And first thing I want to say is to get everybody kind of some clarity. The chart is literally just fundamentals on the screen. That's all it is. So everything you see with economics and news and data, PPI, CPI, all of those things, unemployment, all of that is just showing up on the chart. So what I did, I went back all the way to 1929. So if you can see this chart on my screen, this is all the way back to 1929. You can see down here, 1929. So one of the very first things that I tried to look at on the chart is what is the general direction, right? And before I even look at the chart, and let me know if you can see these other things on my screen, these other tabs. Let me see. Share this tab instead. Cool. Can you guys see it?
Yes.
Okay, cool. So
Yes.
first things first, I know you guys just talked about a lot of people being in the Patreon and in the chat, just kind of, it being a lot of noise and stuff like that. I think that just comes from a lot of people not knowing what's coming up in the market and not knowing what's going on. So first things first, before you even look at the chart, you need to know what's going on in the market. So what I always do is I make a weekly investing outlook. So I know, economic reports that's coming out. I know earning reports that's coming out. I know traps plays. I got my own individual plays. I'm looking at where the futures market is going, right? So I'm looking at all these things. I have all these things already ready before the week even starts. So, Monday was Veterans Day, Tuesday, no notable information, Wednesday, CPI, core CPI, Thursday, jobless claims, PPI, core PPI. So I already knew the market was going to move based off of jobless claims, and PPI today, right? So when you understand these things and you look at economics and all these other things, it makes looking at the chart a whole lot easier. Because a lot of people just try to look at the chart first and they don't understand what's going on. But when you look at economics first, again, the chart is literally just fundamentals and economics on the screen. That's all it is. So first things first, just try to know what is going on all the time, right? So economics, who has earnings, things of that nature. So this is something that I use all the time, and I put this in the chat this week or last week, and I'll put it in the chat again this week for next week coming up. Second thing I look at, this is gurufocus.com. So if you don't use this site, I think everyone should be using this site. And if you go to gurufocus.com, go to screeners, and then go to industry overview. That's how I got to this tab. Now, what this shows me, so over here, I go to 1 day, 1 week, 1 month, 3 months, 6 months.
I don't think we
right?
can see
We
that.
don't see the Guru Focus.
Oh, okay. Can you see it now?
Yes.
Yes.
Cool. Perfect. So this allows you to know every single day what sectors are going up and what sectors are going down. A lot of us are blind because we don't even know what sectors are going up. So we don't even know how the overall market is performing. Once you understand how a certain sector is performing, then you can understand how. So now we're talking about, how some semiconductors are coming down, right? You got companies like AMD, they're in the bear market. You got companies like ASML, they're in the bear market, right? Then you have other companies like TSM, AVGO, NVIDIA, obviously, they're in the bull market, right? Somewhere where you stay. Okay. But yeah, I look at this every single day, and then I go to the week. So I see what sectors are performing over the past week. Then I go to the month. Then I go to the 3 month. Now, me personally, I am a trend trader. So all that means is if the market is going up, I'm doing calls or I'm going long. If the market is going down, then I'm going short or I'm doing puts. Same thing, right? So over the past 3 months, I can see that the top sector that's performing is technology sector, right? So if my job is to just follow the overall direction of the market, I want to be in technology. So that's how I personally find my own plays. So I see the top performing sector over the past 3 months is tech. So that's where I want to be at. So when Trap does like an XLK play, I love that. When Trap does, a semiconductor play, I love that, right? So usually the top 3 sectors are where I want to be at if I'm going long. Sorry about that. And then the top bottom sectors are the sectors I want to go short. So how healthcare hasn't really been returned over the past 3 months, I would be short healthcare. Let me show this tab. And
Hey,
then
Monte,
lastly, before I get, go ahead and
when
say
you
that.
talk about going short, is that you're running shorter plays? So those may be 1 week to a month out, or is that just doing puts instead?
Okay, so going short just means it's doing puts, right? So think of it as when you do a call, that just means you're doing a trade to the upside. And I call that going long. That's what they call it in the hedge fund world, professional world. So that's just what I call it. Going short, all that is, that just means you're doing a put. Now, when I personally do calls, I'm doing them 20 to about 60-day expirations. I know Chap does his a little bit longer. I choose to take, kind of a shorter time frame. And then with puts, when I'm going short, the most I go to the downside is 2 weeks max. Because if you're a Trap, he says, the market goes up 75 or 79% of the time. So if I am going short, I want to be able to make money in any market. That's our job. No matter what the market is doing, if the market is going down, we still have to be able to make money. You actually make more money when the market is going down. So no matter what market we're in, whether it's going up, down, or sideways, we have to be able to make money. So I try to encourage people not to be scared of doing puts or going short, because it's literally the inverse of going long. I just know if the market is going up more times than it's going down, if I am going short, I want to be short for a small period of time, not for that long.
Thank you.
Did that answer your question?
Yeah, no, thank you. Thank you a lot.
Cool. And then this is the last site that I pretty much use before I look at the chart. This is macrotrends.net, and it literally shows you the top 25 stocks by market cap and then the top 25 stocks by dollar volume. Now, I want y'all to pay attention to the right side where it says stocks by dollar volume. So this changes every single day, and it lets me know how much money is going in or out of a certain stock. So you see at the top, there's actually more money flowing in and out of Tesla than it is Nvidia. So earlier I heard y'all talk about, someone coming in, someone who's new, and then, they just do a Tesla play, and then they don't have the capital, or they used all their money. Now they don't know how to, they don't even have the mental capacity to take a 20% loss or a 30% loss, and it's Tesla, so it's moving very, very volatile. So that's gonna hurt a lot of people, right? Now, me personally, you have to know who you are as an individual first before you even try to trade. I know me personally, I don't like stuff just going up super fast. I don't like things being volatile while I'm holding it. I like things a little bit less volatile, right? So personally, I know that Tesla is not something that I would trade. Tesla is something that I've invested in. I'm up 94% on Tesla long term for the past year and a half. But I know that personally, just options wise, it's not a stock that I personally want to trade just because of how volatile it is. But this allows you to see how much money is just flowing in and out of each stocks, and it can also help you with volatility. If you have a question, you could just say it. If you got your hand raised, anything like that.
Where did you see, I guess, how are you determining that Tesla is volatile? Is it just because of the volume? And if so, what's the threshold on that?
Threshold, okay. So personally, no, I'm not really just looking at the volume. It just comes from me. I've been investing in Tesla for a minute, a year and a half. I've been looking at it for probably about 2 years or 2.5 years. So just learning the stock, and that you get a lot better with it after you invested in the stock personally and you're looking at it, watching it. Since I've invested in Tesla long term, I already know. So like Tesla, I was texting somebody today. Let me pull this up real fast. I was texting somebody in the group yesterday, and he asked me about Tesla, and I told him, I said I got Tesla coming down to about between $313 and $300. I said that was Tuesday. And then if you look at Tesla today, then that's where it came. So just, if you just look at the chart itself, you can tell it's volatile. If you look at it percent wise, it ran
Tell me
up.
what I'm sorry. You said if you just look
Go
at the
ahead.
chart, you can tell it's volatile. And I know you've been looking at it probably for a long time. So
Oh,
it
we didn't break
automatically
it
immediately
down.
jumps out at you.
Got you. Got you.
But for someone like me, I'm like, all right, you saying it's volatile, but okay. Where are you like, is it how many
Got
times
you.
it's going up and down? Is it what is it that makes it volatile when I look at
Volatility
this?
just people in and
Got
out,
you.
right?
Okay. Yeah, I mean, you can look at, so you can look at the volume. You can see how high the volume is at the bottom. So these green and red lines at the bottom, those are called volume lines. So all volume is just how many people are buying and selling total, the stock. That's all it is. How many people total are buying and selling the stock. So if you look top left over here in this corner, it shows you the exact number. So you can see that it has 3 billion volume for this specific week, or this specific week it had almost 2 billion in volume. But if you just look at the chart, and I'm do a measurement, Tesla from the top to its low in January 2023, it dropped 73%. So that's a stock that's very, very volatile. Versus if you look at a company like Walmart, let's look at Walmart.
Are you in Guru Focus right now? Is this
No, I'm on Tradeview right now.
Trading View?
Yes, ma'am. Yes, ma'am.
Thank you.
Yep. Now, if you look at Walmart, Walmart hasn't really had over the past, really since, I mean, you could go all the way back to 2015, or you could go back to 2022. Walmart hasn't really had a steep drop like Tesla has had. Walmart hasn't dropped 70% in value, right? So Walmart is not as volatile. Does that make sense?
Yes, I see it now. Now that you put Walmart up.
Got you. And then I like to compare stuff to everyday, just everyday living. So if you have a jacket, right, that is $100, and then the price of it drops to $30, well, that's volatile, right? If it can go back up to, $100, then, that's volatility. Just the up and down price movement of something, right? So that's very, very volatile. And a lot of people don't have the mental capacity, or a lot of people don't have that experience to be able to sit through a 70% loss. Now, personally, if you invested in Tesla before, like 2020, then I'm sure you can endure those losses. That's why a lot of people, they lose money with crypto, because it swings. It's very, very volatile. If you look at Bitcoin, it went to, 20,000, then it went back down to 3,000. If you held it long term, you made money, but a lot of people are not able to, hold through that volatility. So just knowing that, if just going back to the beginning, knowing who you are as a person, if you don't like that volatility, then, don't trade a stock like Tesla. Don't do an option call on a stock like Tesla. If you want more, slower, steady returns, then do an option call on something like Walmart. So we have to know, like, what stocks in the market are volatile and what stocks are not. That's going to help a lot of people just fizzle out a lot of stocks that they just don't need to trade, because they're not ready to trade those stocks yet.
Hey, you say that, but Trap's method is, invested in movers. So Tesla is a mover, whether
Right.
it's up or down. I'm in Walmart too. Walmart is not a big mover, but yeah, I've been steady climbing. Like you said, you ain't really got to worry about it. You can put that on autopilot and just let it go. You got to look at it every day. So,
Right.
like Nvidia, that's a mover,
Mm-hmm.
but that's not volatile like you comparing to Tesla? Question.
So Nvidia is volatile too. Nvidia is very volatile. Nvidia is up 200% for the year. That's volatility. Like, if you just, so I want us, the first thing first, I want us to just look at the chart, and I want you to see how high up the chart is going. So you see how it's like a steep curve to the upside? That
I think what you're
automatically,
saying You're saying like it's like it has the highest of highs and the lowest of lows.
Right. It's almost like between two levels, right? So let me think. I've tried it almost every stock.
It makes huge swings. It'll swing all the way up and swing all the way down and swing all the way back up and swing all the way back down, and it just continually does that. It's like a major roller coaster ride.
Right. Now I'm on the weekly chart, right? So I use the weekly chart, the daily chart, and then I use the 2-hour chart. Those are all the time frames I use for my entries with options. If you go down to the daily chart, like if you go back to, like, everyone talks about NVIDIA, but nobody was really talking about it when it had this drop in 2021. So if you were investing in NVIDIA in 2021, you lost, if you invested in it at the top, you lost almost 70% of just long term. We're not even gonna talk about an option, but if you were just holding it long term, you lost 70%, right? In about literally a year. You lost 70% of your value holding a great company long term over the course of a year. That's just long term. We're not even talking about options. So just imagine how volatile it would be, on the option side. So, like Chap said, NVIDIA is a mover. He likes movers. I like doing both. I like doing, like, NVIDIA, it moves enough for me. It doesn't move too fast. Like Tesla just moves super. It moves way too fast for me personally. Like, you have to get a good entry. I'm big on not having drawdown, which just means as soon as you have an entry, you're not down that much, if that makes sense. So we have option contracts for like 3 months and 6 months, right? That's what Trap usually does, 3 to 6 months options contracts.
Yeah.
Just to make sure that's what he does. 3 to 6 months.
But I got what you're saying, because when Trap do hit an entry, we might go back 10, 15%. But you looking at capitalize immediately.
Right. So that's just my personal take. Like, I don't because a lot of people don't understand. Your win percentage does not dictate how much money you're going to make with options. It's your risk to reward ratio. You can win 10 times, right? You can win $1,000 10 times, right? So you made $10,000. But if you lose one time and you lose $3,000, well, you just went from 10K to 7K. If you lose again, then you went from 7K to 4K, right? If you lose again, then you went from 4K to 1K. So you won 10 times in a row, but it only took you 3 losses. Now you only have $1,000. So it's your risk to reward ratio that really determines how much money you make. I can't stress that enough. From all these books I've been reading, and everyone should get this book. It's called Trend Following by Michael Covel. It's one of the best books on investing, in my personal opinion, ever. But
I appreciate that.
It's called Trend Following by Michael Covel.
I think also too, if you have better entries, you don't have to go as long because you don't have the you don't have to recover, because you're going in with the bad entry, and then now you need that time to recover to break even. If you get a really good entry, you can scale much faster, and then you can go with a shorter time.
And then, like, another thing, that's why I keep trying to emphasize, like, the technicals, the chart is just fundamentals on the screen. But sometimes, okay, I'll put it like this. So we know, like, in a movie, right? We could watch a movie, right? And we already know, like, something that's going to happen to one of the characters before they do. What's it called? Foreshadowing or something like that. So we'll already know, like, what's going to happen to another character, but they don't know yet because we've seen another scene from another character. Does that make sense so far or no?
Yes. Yeah.
That makes sense, right? So with the chart, so you have economic data and all this data that comes out all the time, right? You got earnings that come out. You got, real retail sales. You got, industrial production. You got inflation, right? You got Jerome Powell in the meeting that he has, right? And he talks, right? You got all this news that comes out, right? But the chart tells me when it's time to go, right? So you got all this news coming out. You may have it may be some bad news about a stock that comes out, right? And then, but the stock is still up. The chart didn't tell me that, it's time for the stock to come down. That's why I just wait. Like economics tells you what's about to happen, but the chart lets you know exactly when. The chart helps you with timing. That's all charting is. So like how Trap, mostly he just used fundamentals. That's amazing just because, he can tell like, okay, based off of, this economic environment, this is what the market is going to do, right? But if you pair that with the chart and timing it better, then you're going to have way less drawdown. You won't have, 30% drawdowns or, plays where you're down 30 or 40%, right? So it's just about, using all these tools that we have access to become better investors and become better traders.
All right, I got a question.
Yep.
When you was back on Guru Focus and you was looking at what the market was rewarding, is that similar to the heat map? Yeah, that or FinViz that Trap uses?
It's similar. I use a heat map. It's called Wallmine, but you can use either or. I just like to use this one because it shows me the sectors, right? I don't think the heat map just shows you sectors, but it doesn't consolidate it. I try to make things as simple as possible. I try to, have a certain system where I look at certain things. I'm looking at the same thing every single day. And then, I'm trying to capitalize off of the same thing every single day. It's rinse and repeat. Like Trap says, rinse and repeat. Do the same thing over and over and over again, right?
On a FinViz, I think you can go to, instead of maps, you click on groups and it shows you those lines just like that.
Cool. Perfect.
Is this the free version?
If you go on FinViz, instead of clicking on maps, you click on groups and it'll show you those green bars like he kind of has for sectors.
He was wondering, is that
Cool.
version a free version of it, or you have to
Monte,
buy into it?
the version of Guru Focus, is it free to get this view here?
This?
Yeah.
To get this?
Yeah, to get that view, yeah.
Yeah, this is free.
Okay.
So everything, I use the free version of everything. The only thing that I use that's not free that I'm gonna be using soon is called TrendSpider. And I think a lot of y'all benefit from that as well, because TrendSpider, so how I have to draw all the support and resistance and all the trend lines and stuff on the chart. And I'm gonna show you guys just so you know what I'm talking about, because I don't know what stage everybody is at.
Are you saying TrendSpider or Spotter?
Spider. So it's called Trend, TREND, and then it's SPDR.
Gotcha. Thank you.
Yes, ma'am. So how I have to manually draw, all of these trend lines, right? Now these squiggly lines, those are called moving averages. It basically gives you the average price of what a stock has been at over the last however many days. So this red line, that's the 400-day moving average. That's another thing you guys should know. Anytime that we drop to the 400-day moving average, that's pretty much the best time to buy. 2020 we fell there. I think 2016 we fell there. 1929 we fell below there. 1985 we fell there too.
For buy and hold or options or both?
Buy and hold. And then if you're doing leaps, you can do it too. Like, yeah, I went all the way back to 1929 and I looked at what's the best place to buy at long term. 200-day moving average is first. That's where it's gonna come to first. And then below that is the 400-day moving average. And you gotta know, like after a while with time of just studying, you'll know like, okay, like a pandemic, all right, we're gonna drop to the 400-day moving average because that's something like that's crazy, right? If we have war with, let's say, China, then we're gonna drop to the 400-day moving average, right? But if we have something like with CrowdStrike, right, where they had the blackout or they had the, the data leak or whatever they said they had, right? That was a drop to the 200-day moving average and we recovered quickly after. So I use those as like my two, that's the base of my investing for long term. I use other stuff, but those are the two main factors. Like if you just buy the 400-day moving average and the 200-day moving average, it's going to be really hard for you to lose over a 5 to 10 year period. You're going to make a lot of money.
Are you using simple or exponential?
Always use exponential. It fits the price of the actual asset better.
Thanks.
Why? Sorry, I just want to understand.
So I can't remember too much. I looked it up. But I think simple, it doesn't calculate and fit the data. It doesn't fit the price as well as it does as an exponential moving average does. Because I remember looking up myself choosing between the simple or the exponential, and then I looked it up, and then I just found out that the exponential usually fits the price better. So if it's fitting the price better, when the price comes down to the moving average itself, then you'll have a lot better chance of actually executing and getting a more precise entry. Like if you look at CrowdStrike on a daily chart, it dropped exactly to the weekly chart. Like it hit the 200-day moving average, and then it's been going up ever since. So literally, if you just use this as a long-term first, maybe if you use it for options, just do leaps. You can use it for options, just do leaps. But long-term, pretty much any stock, once it comes to the 200-day moving average or 400-day moving average, that's where all the hedge funds are buying it. So that's where you want to buy it.
Is that when you're looking on the weekly chart?
Say that one more time.
I'm not sure who asked about the moving averages, but the difference between the two is the EMA moves faster and it gives more weight to the most recent days, where the simple moving average, like all of them, like equate to the same. It's like equate to the same values.
Gotcha. Cool.
And when you're looking at those moving averages, are you at the weekly chart or daily chart when you're looking at those entry points?
So I only use them on the daily chart and the weekly chart. The weekly chart is obviously, so the higher the time frame, the stronger. Like, would you trust somebody you met for a day, or would you trust somebody you met for like 5 years? Obviously, we're gonna trust the person for 5 years, right? So the higher the time frame, the better it is. I switch between both. So really, like long term on the weekly chart, if a stock comes down to the 200-day or the 400-day on the weekly chart, that means something is wrong. Like something is wrong. Like ASML, it went down to the 200 moving average, and then it started to bounce up, right? But if you look at stuff on a daily chart, the daily chart, it's almost like a precursor, right? It's almost like a shorter time frame of window. If something goes to the 200-day moving average on a weekly chart, then it might not come back there for another 4, 5, 6, 8 months. If you do something on the daily chart, it might not come back for another 3 months, if that makes sense.
Show that with KLAC.
KLAC.
Cool. Yeah, what you talking about right now?
All right, cool. So KLAC, if you look at it I'm on the weekly time frame first, and then I'm using Heikin-Ashi candles. So it's different than the candles that pretty much everybody else uses. So if I change it to these candles, it's a lot harder to see the general direction, in my personal opinion. But if I change it back to these, then the direction becomes a lot more clear of where the stock is going. So KLAC, it's in the ascending or descending triangle pattern. So usually, like, it's gonna be one or two things that's gonna happen. Either it's gonna move, it's gonna keep ranging, and then it's gonna break this trend line and go to the upside, or it's gonna keep putting downward pressure on this orange line and then break below it and go further down. But as far as the moving averages, you see the 200-day moving average is right here. So long term, if KLAC goes to the 200-day moving average on a weekly chart, that's where I look to get my first entry at. But if you look at it on a daily chart, then you can see it's already below the 200-day. It's at the 400-day. And anytime like a stock, so I go short when the stock is above all moving averages, or I go long when the stock is above all the moving averages, and I go short when it's below all the moving averages. Like it's coming up to the 400-day moving average. So on the daily chart, this also could be like a precursor entry for you as well, shorter term. But first, I just like getting a stock at a very, very extreme level. Like I bought Tesla at $165. So now when I buy Tesla at $200 or $211 or $250. I already bought it a long time ago at $160, so I feel more confident doing that. Like a lot of people, they'll buy stocks at, like, let's say they try to buy Tesla at, 300, right? And then it goes down to, let's say, 250. Well, if you didn't buy the stock at, $160, it's going to be a lot harder for you, one, to cut the loss because you're trying to hold on to it. And then two, that's your first entry for that stock. So you had a bad experience with that stock. Now you don't want to invest in a great company again. But as far as K-Lock, I said this on the, I put this in the chat in the Patreon too. It's either one or two ways. Well, I personally think, just based off looking at it, it looked like it's probably gonna break this and go down. But it just depends. That's why I said the chart tells me when. Like the chart tells me when. You gotta wait on the economics and all these other factors to play out, because it might keep going up, for a little bit, and then it'll break down, or then it'll break up. So it's just a waiting game with K-Lock.
So you talking all the way to February right now?
Let's see, if you just average like the speed of the move, August to 16th, and then September 11th to October 15th. So that's a month. And then what was this, October 15th to November. So usually K-Lock, it looks like it takes about like a month, like 2 weeks to a month for it to like swing up or down, but it's gonna get shorter and shorter and shorter. Like the closer it gets to fulfilling, like the stock can only go three ways. It can only go up, sideways, or down. One of those three things is gonna happen. Our job is just to try to find information and be on the right side of whatever move happens. So, over the past, like just looking at it, so the time it takes to go from this point here, right? This was June or July 11th. For it to come, to the bottom, that's August 5th. So that's about 3 weeks, almost a full month, right? And then the time for it to, come from August 5th, to the high of, which was August 15th, that took, 10 days, right? Which is, 2 trading weeks. So it's probably going to take maybe another month or two, month and a half for the, pattern to play out, or it might just break right here. Like as soon as it breaks below this orange trend line and below this red 400-day moving average, that's when I personally look to go short a stock. But K-Lock is not personally on my personal list. But just any stock, that's how I'm looking at it, no matter what.
Oh, this thing ain't gonna be 20.
and the other thing too is this affords you the ability to not have to guess. You can wait for the trend of a stock to trend up, and you can still get it at a discount. It's not like you have to time the bottom, but you can wait for that uptrend and then say, okay, now I'm going to get in. That's what, to me, that's what reading the charts also is very helpful, because you can confirm which direction before you move instead of kind of guessing and hoping,
Right. I feel like a lot of people, I know this was like when I very first started trying to trade and stuff, it wasn't that I was getting the direction. I was getting the direction right. I didn't have good entries. So I'm getting stopped out all the time. And I feel like that happens with a lot of people. Like trading and doing options, you got to look at it like it's literally like a sport. Like how Trap says that, Ian says that, anybody who's really successful, they talk about 10,000 hours. They talk about working on something hard all the time. But with trading, like I've learned that 90% of it is literally just waiting. Right? It's just waiting. A lot of people, they do different stuff. They change their system. One day it's moving average. One day it's this. One day it's that. Right? So I had to learn through all those mistakes to stick to one thing and one thing only and master that. And then, once I started getting I always pretty much had the direction right, but then I focused in, okay, what am I not good at? It's the entry. It's the entry. That's where I keep losing money at the entry. So I had to, take the time to channel and find like what personally works for me. So I chose, when the stock is below all the moving averages, then I'm going short. When it's above them, then I'm going long. It's pretty simple. And then if you look at it like over a long period of time, if you just go back, and you can do this with any stock, just looking at it, if you see it's above, the blue line, the stock is generally going up. It comes down and hits one of the moving averages. Once it goes above the moving average, the blue moving average again, which is the 20-day, the stock is generally up. Same thing, same thing, same thing. And then once the stock usually goes below all moving averages, that's when I know it's going down. So like personally, I have Micron. So Micron is a stock that I'm short. Go ahead.
You shorting it?
Yeah, so like Micron, so it has a triple top right here, right? So when it breaks this orange line, then that's when I would look to go short to the downside. And then like this is something I learned later on, but you can short. So like from the 200-day moving average to the 400-day moving average, you can use that as like support or resistance to short. So I was short from the 200-day moving averages down to the 400-day moving average, and you can use that as like a moving average strategy that you can use.
What's the orange line?
The orange line. So let me go down to a 2-hour chart. Let me take off the moving averages and all this other stuff. So if you look at this orange line, right, you can see, right here, Micron came down to that level, right? And then the buyers came in and pushed the price back up, right? They came down here again.
You explaining it.
Say that one more time.
Say that price, the orange line on while you explaining it. Looks like $99.
Yep, almost $98.93.
Okay.
So $99, same thing, right? So if I'm looking at it, and I just draw a rectangle, right? So sellers are in control right here. They knocking on the door, right? They want to go below this price, below $99, but buyers came in and said no, right? It came back down again. So the sellers, they knocking on the door again, right? They want to blow the wall down. They want to get below $99, right? Not happening. So they came up again, and then they down here again, right? Now, this is a specific pattern. So you got double tops where it did it twice. So it went up, came down, went up, came down, and then it breaks. And then you have triple tops. So a triple top is just when it does it 3 times. So what it's doing now, it came down, it went back up, it came down, it went back up, it came down again. And usually on the 3rd time, it breaks to the downside. So this is just, a strategy or a setup that I personally have or that I personally use. So this is when you get into chart patterns and actually, memorizing patterns that the market gives you. But you can just look up like chart patterns and it'll tell you, you can look up chart patterns and they'll tell you like which chart patterns indicate what, or what I also like to do. So I use ChatGPT a lot. So I like to get both fundamentals and the chart because they go hand in hand. So I say, okay, what economics or fundamentals usually are associated with this pattern, right? So like a cup and handle. So if you guys looked at, somebody said Lululemon did it, Tesla did it, and Zoom did it, Robinhood did it. So it's literally just like it's like almost like a cup. Like the price is going down, 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 and it's almost like it's like a U shape. It's like a U shape. And usually when you have that U shape come, and then the stock usually blasts past that. So that's why Tesla, like I already knew Tesla was gonna blast past that just because it was forming that cup. But for Micron, this is just once it breaks below this line, then or it closes below this line, then that's where I'll be taking an entry at on it.
When you had your moving averages, what do you got? The 50, 120, 200, and 400? What are the moving averages? that you have?
Okay, so I use the 20 day. I use the 72, and that's important. That's what hedge funds use. You can use the 72 as like a quicker entry. I use the 100, the 200, and then the 400. 400 and 200 are for long term. I really don't use the 100 that much, but I just have it just to see how the price usually reacts to the 100. And then the 72 are in the 20 day are what I use for trading.
For entry when you say trading?
For entries.
Why do those work? I never heard those numbers. 72.
So the 72 day moving average is what hedge funds use. That's the moving average that they use. So a lot of things that we use on the professional side, they don't really use them. Like if you read, so I read like a lot of books. I read Trend Following by Michael Covell. I've read Market Wizards. I've read Beat the Dealer by Ed Thorpe. I've read Intelligent Investor, Went Up on Wall Street. I've read all the common books. But when you start reading other books like about hedge funds and you start reading stuff about like their strategies and what they do. So like right now, the strategy that I've been researching or that I've been learning in the book is called time series analysis. So that's using machine learning, LLMs and stuff like that to automate your trading strategy. So that's the next step for me. That's where I'm trying to be. Just audit like everything I'm doing right now. I'm trying to have write code to have it automated.
Do you not use volume profile at all?
Volume profile, that's something you could use. I use that for more so long term, but that's a good thing for the use because it shows you where the hedge funds are buying it as well.
So if you were like once it hits that orange line, what is the play you would put in?
Okay, so first thing, I will wait for it to close below. That's why I said 90% of trading is just being patient and waiting until it closes below. Like I need a candle that fully closes below this orange line. Do y'all know what I mean when I say that or no?
No.
Yes.
Okay, I'm gonna explain it. So let me get it closer. All right, so boom. So right here, this candle is above, it's above the orange line, right? We can all see that it's above the orange line, the body. When you look at, you see how it has this small little line at the bottom? And then it has like its field in the middle. The middle part is called the body, right? So if you look at this candle, right? And if I was talking about, if I made this level orange, or let me make it green, right? So the body of it closed below this level. It closed below the green line, right? So then that's when I would take an entry if I was going to do it at that level, right? But that's not the level I'm doing it at. But once it comes and it closes below this orange line, like this body, once it looks like this over here, then I'll be taking an entry. Does that make sense?
Yes.
Okay, cool.
So your orange line is the 400 day?
No. So the orange line is support and resistance. So you know how Trap has he gets it off bar charts and bar charts.
Oh, okay.
Yeah. So bar charts, they give you like 3 entry. They give you like 3 support levels or resistance levels, something like that. I personally don't use it. I've always just looked at it myself and tried it myself. But literally all support and resistance is just levels that the market respects. Like it's levels that the market goes to where it comes down a lot or it bounces up a lot. So if we look at,
is that orange line, is that the first support for you?
First support as in what?
Like the first support level, how you have the first, the second, and the third on bar chart.
Right. So I kind of take So I have my own strategy, but I pull from kind of what Trap does to help me with mine. So I don't use like the 3 levels. Like I'm only taking, like to put it in perspective, I'm only taking 30, like max 30 trades a year, options long term. So my goal for myself is to have trade less and make more money. So that means when I'm looking at the setup, it has to be like I'm not just peeping in and out, right? I'm not day trading. I'm not peeping in and out. I'm looking for a really, really good setup that's, it's called asymmetrical risk to reward. So that means the upside of what you're about to do has to be very, very high, and the downside of what you're about to do has to be very, very low. So every day we get in the car, right? We drive to work, we do whatever we got to do, right? The probability of us getting into an accident, well, I don't know where y'all live, but where I'm at, it's not that high. Right? It's not that high. Right? That's asymmetrical risk reward, right? You're driving the car so you can go to work, so you can make money, right? That's high probability because one, you're making money when you go to work and you're being safe, right? You haven't lost your life. So that's something that's asymmetrical to the upside in your favor. When you're looking at stocks and charts, like I want us to apply everything that we have done and experienced in our life, and y'all older than me, so y'all been through more stuff than I have. So apply a lot of stuff in your life to investing. All of it is the same thing. It's the same thing. Like investing and trading is literally just learning about that's all it is. But like if you see, so this is my hypothetical trade that I'm doing. So my stop is $1.15. Right? So that's not a lot of room. So I'm real precise with my entries. But my target is $8. So just imagine if the option went down $1, I might be down like 5, 10, maybe 15%. Right? But if it goes up $8, then I'll be up what 70, 80%. So if I lost 10%, but I made 80%, then my risk to reward ratio was 1 to 8. So I made 8. My win was 8 times more than my loss was. So I'll always be good no matter what. Like I can lose. I can lose probably about. I can only win 5 of my 20 trades that I'll take in a year, and I'll still be profitable just based off of my risk to reward. That's why I emphasize like it does not matter how much you win. It's about how much you risk versus how much you're losing.
All right, so this is
Monte.
Go ahead.
Oh yeah. So sorry, I just wanted to say it reminded me of an investing course I took with Darren Winters about winning more than losing, like the ratio. So just to clarify your chart on TradingView, do you have it on which time interval? Like, is that like a 4 hour? Like what are we looking at right now?
Yep. So if you look at the top left where I'm moving my mouse at, it shows you the intervals I use. So I don't use odd time frames. I always use even time frames just because like in life, everything is always better when you use an even time frame to me. But I'm on the 2 hour right now. I'm on the 2 hour chart. I use the daily chart as well. And then I use the weekly chart. But I go from the top down. So you want to zoom out with everything. Invest in 2. So if you really want to know like where the stock market is going to go, you need to zoom all the way out and you need to look at our relationship with China. You need to look at where capital is going. Like Saudi Arabia, that's a whole nother country. They've invested $100 billion into AI with NVIDIA and Microsoft. So that's telling you like the semiconductor space is going to do well. The AI space is going to do well. So you got to zoom out. Same thing when you're looking at a chart. You need to go from the weekly time frame first, then go down to the day, then go down to the 2 hour. And I use the 2 hours, the smallest time frame that I use.
Okay. So your system in the day, well, first of all, Sunday night, you come up with your investing strategy. And then when you go in the morning, you look at the weekly chart first, then the daily chart, then the 2-hour charts. Do I have that correct?
Yes, ma'am. Always keep the process the same. You got to do the same thing over and over and over every day.
Thank you very much. You're so smart for being 20. Oh my gosh.
Thank you. I appreciate it.
Travion, I have a quick question.
Yes, sir.
This is for Travion. How do we get the recording of this this meeting?
Yes, please.
I agree.
After the call, it should be ready in about 12 hours. They'll send me the link once it's been processed, and I pretty much just been putting them in the chat, the link, the recording, so I can do that 4 or 5 times a day because I know the chat gets full and messages get lost in there. But I always label it.
Davian,
right,
I have
Davian.
Yes, this was awesome. Thank you so much.
Thank you,
It
Davian.
is.
If we have that private WhatsApp, we could just pin that link once.
That's true. Yeah,
I like that
it too.
idea.
That's great.
I like that idea.
Monte,
I'm all about simplicity. I don't want you to do any more work than you have to.
I definitely don't mind being in the chat. That's my therapy in the morning.
mine too.
So the best way to start the WhatsApp chat, how do you guys think you want to do that? Like, in that Patreon, it's hard to link it. Maybe you could do the WhatsApp chat and put the link in the Patreon, but I guess you guys don't want to do that because you don't want everybody in it, right?
Everybody gonna be in it then.
Well,
So
wouldn't it be wise for everybody to maybe share their emails in the chat here, and maybe can you get the emails from everybody from this chat?
Yeah, start it here. Be better.
Yeah, I can do that.
Yeah, because I mean that would kind of reduce, the overflow. Otherwise, you're gonna get people thinking you remember how last time, oh well, you're keeping it from certain people, all this foolishness.
Yeah.
Dave, you could give us your email.
How you doing, by the way, Miss Holmes?
Oh, I'm good. I mean, Danny, Brady, she told me, she was like, hey, hey, the meeting is going. I was like, meeting? What meeting? So I hopped on really quick, and Monte is doing excellent. I mean, I'm intrigued by charts because I'm actually reading a charting book now. And so he was telling me all these different things, and I'm like, this sounds so great. Because I mean, you can just only add to your game. So I think this is great. Thank you, and thank you. And Monte, thank you.
Yes, ma'am. Thank you as well.
Yeah, Monte. Thank you, baby.
That website that you show where you look at news, what is that website?
The site that I look at news?
You first probably showed it.
So for news, I look at a few different websites. I look at CNBC, obviously.
Yes.
I follow a lot of different accounts on Instagram. So like anytime I open Instagram, I'm seeing something about investing. I'll share those with you because I don't know if y'all use Instagram or not. I don't know. But if you're not, then I'm gonna go.
They're not that old.
I'm sorry.
Yes, we are. I am that old.
Come on now.
Something you
everybody use different stuff, right? Everybody use different stuff. But
so what you showed us earlier, was that maybe something you typed up on your own?
This
just put it in the WhatsApp.
Talking about this?
Put all the links in the WhatsApp.
That right there.
Yeah, so this is something I made. Like I made like some, and then here's another tip. So future is like, I know we don't trade futures, but you have to look at futures. You need to look at that first. That's going to tell you the overall direction. Like futures, they're open from 5 p.m. to 4 p.m. So they only close for 1 hour. All the hedge fund managers like Warren Buffett, Ray Dalio, Ed Thorpe, Paul Tudor Jones, these people have like a lot of money. Like they have a lot of money. They're trading futures all the time. So if you look at the futures market the night before and the morning of at like 7 o'clock, it's going to give you a pre-direction of what stocks are going to do. So before the market even opens, I already know pretty much what the general direction of the market is going to go. And then I also look at So this is how I do it. This is exactly my process. First thing I'm doing, I'm looking at, economics. I'm looking at this first. This is the first thing I'm doing. I need to know what direction the futures market is going. I need to know what economic reports are up for the week. I need to know what companies have earnings. So shout out to everybody who made money on that Kava play, right? And that shot play and that Spotify play. Shout out to everybody, right? You have to know, it's important for you to know if you don't know what's going to happen when something happens, you're not even going to know, right? If you have a test coming up and you don't study for it, you're going to fail. Something like this is so simple for us to just be prepared, but it's just a lot of information. Like, a lot of people, they're not looking at the right things. They're looking at outside things. Like, they're looking at tweets, right? Every asset on earth is created to go up. That's what it was created for. If it wasn't going to go up, then they wouldn't have created the assets, right? All assets are meant to go up over time. So, like, when someone says something about a tweet coming out, or a company missed earnings, or something small, zoom out and look at something over a 5-year period or a 3-year period, and you're going to know the direction of where it's going to go. But first thing first, futures. Then I'm looking at economics, because economics are the main thing that drives the market. Economics and earnings, how the debt to GDP ratio is, that's driving the market. The inverted yield curve, that's driving the market. CPI, PPI, jobless claims, real retail sales, those are the real indicators that's telling you where the market is going, right? So if y'all start looking at those stuff, because the market is connected to the economy. I don't care what nobody say, that it's connected, right? If it wasn't connected, then we wouldn't have bear markets. We wouldn't have drops in 2020, right? So it's all connected. So these are the main things you need to look at. You need to look at the futures market. You need to look at the economic reports that's coming out. And then you can just go to US economic calendar. That's where I get the actual information from. Or you could just wait till I post it in the chat.
Are you posting it with the green, like highlighted like that, or is that as a result of after you already looked at it?
So if it's green, that means the report came in either at expectation or better. And then if it's red, that means the data came in below expectation or worse.
I guess what I really want to know is, like, so you have this Thursday here. Today is Thursday, right?
Mm-hmm.
Were you able to tell, like, the market was going to go red today? Because somebody posted in the group this morning, I don't know if everybody else saw that, oh, the VIX is down. So that means it's going to be a good day in the market. Clearly, that's not what happened.
That's another thing. So everyone, like, okay, the VIX, literally the VIX, it wasn't created till like 1985. All the VIX is meant, it just shows you like the volatility of the market. That's why I use the trend. That's why I'm a trend follower, right? I capitalize off of market volatility. So you have, okay, like, this is a little bit deeper, but when you look at a chart, right? Anything that has like prices, it has moments where, like, the price is not where it technically should be, if that makes sense, right? So when the VIX goes to like 60 or it goes to 80, right? Then that means the market is down. That's the perfect time for you to buy. Just because the VIX is low does not mean that the market is going to go up, right? Now, over time, generally, if the VIX is down, then the market is going up, right? So if you look at the VIX, once it goes past 35, like in between 35 and 80, then the market is pretty much falling quick. And another thing, when the market is coming down, it falls 2 to 3 times faster than when the market is going up. Just knowing that, when you know that and you see the market is falling, everyone is scared when the market is falling, right? So usually the market goes up for 5 days, 5 to 7 days in a row, and then it'll come down for about 3 days in a row. So just knowing that, okay, we've been up for 5 to 7 days, I'm already expecting a pullback, right? We've been down for 3 days. Like right now, we've been down for 3 days in a row. So probably coming tomorrow, depending on economic data as well, we'll probably open up flat or to the upside.
Yeah, the VIX can be down and the market can still just be trading sideways. And a lot of times that's just due to the economic news that's coming out for the day.
Right. So on his paper, he had a few things listed for Thursday. What did you see? Like, was there something on there that let you know, like, hey, the market was going to be down today? Is what I'm asking, I guess.
Okay, so when you go to so Thursday, right? This is on US economic calendar. So Thursday, 8:30 a.m., right when the market opened, right? You got jobless claims, right? We know how important that is because, you know, Jerome Powell and everybody, they're talking about, you know, we have to keep employment low, right? If you have high unemployment and high inflation, that means people are not having income and prices are going up. So that means the consumer is squeezed, right? So that's not good. So we had 217,000 jobs come in. The estimate was 220,000, right? So that's good. That's a good sign. But what happened was you got producer price index, right? It came in at 2%. It came in at expectation. And then you had core producer price index, right? It came in at 0.3%. So if those are higher, then that's not good for the market. Producer price index, that's just basically, that's the how much prices have went up on the seller side, not on the buyer side. So consumer price index is for us. Producer price index is for the sellers, people who are selling us stuff like that's your Walmarts, that's your Amazon, your individual sellers, like those people. So looking at this data, you know, this data coming in, like when I saw it didn't hit expectations, then I already knew the market was pretty much gonna go down. Like you have to know what so when you're trading and investing, just looking at the market, you have to have an idea. This goes back to like simple principles of just being like what my mom tell me all the time, or my mom used to tell me all the time as a kid, you know, be on time, be creative, be innovative, do your best, right? All those principles matter when you're doing this. So we have to have an idea of where the market is going to go. And your idea could be wrong. That's perfectly fine. Like my idea, I'm just going off of economics. So I'm looking at economics and I see, okay, based on this data that's coming in, I think the market is going to do this. I could be wrong, but I have an idea. I'm not afraid to switch my idea when the market does something different.
Hey, what's your stance on the pre-market?
You said my stance on pre-market?
Yeah, you know, people are always in the chat talking about the pre-market is running, and then when the open comes up, went the other way.
Right. So, I mean, just off of, just looking at pre-market, like don't pay attention to pre-market until it's like 8:15. Right, because that's why I said pay attention to futures. Pay attention to futures. People look at pre-market of stocks or the S&P 500. Futures is telling you where the market is going because their futures is most liquid. Like the most people are trading futures at the same time the stock market is open. So it's 8:30 to 9:30, my time. It might be 9:30 to 10:30 other people's time, wherever you at. But futures gives you the real direction of where the market is going to go. Pre-market, it just tells you what the stocks are doing before they open. But pre-market is not economic data. Like pre-market, that's why I said we have to stop looking at stuff that does not drive the market. Pre-market does not drive the market. Economics drive the market, right? Earnings drive the market. And then you have news or, you know, new things that come out, new innovation that drives a market. Those are the three, those are the three things that drive the market. Those are the only three things that I focus on because those are the three things that actually matter. I don't look at nothing else.
The other thing that came out today too that can send the market kind of into volatility is Jerome Powell speaking today as well. So when you're looking at news or whatever, whenever you know that the Fed is going to speak, the market will go flat. Or, I mean, very rarely have I seen it like really run. And then usually the market waits to hear what Jerome Powell says. And then it kind of picks a direction. And I think you could see that, like, I think when he started speaking, everything kind of went down. until like the last like 5 or 10 minutes. You know, things kind of.
Yeah, the market don't like it when he talk, and the longer he talks, the market really hates it. But yeah, he said too, because he mentioned today too about like that we might not get another rate cut this year, and the market don't like that because they trying to price that in, and that was another thing, and that's also like what you're talking about with the PPI number, whatever the number was. So it didn't meet, so it's showing that inflation can go back up, and he might keep rates higher for longer. You know, so the market don't like that.
Yep. But like another thing is like, okay, Jerome Powell said, okay, that's a short-term effect on the market. That's why I don't really pay attention to it. What he says is going to have a short-term effect, 3 days, right? The market usually falls for 3 to 5 days. It goes up for 5 to 7. So like anything, like something has to be drastic. Okay, so going back to like Newton's law. So every action has an equal and opposite reaction. So for the market to come down, it has to have like a overpowering effect to come down, because naturally everybody wants the market to go up. We all want the market to go up. Traders, investors, like look at the market over a long period of time. It's went up. So that's what we want. But I'm not going to be on the wrong side of history. November is the best month for stocks historically since like forever, since like 1920. December is the 3rd best month, and then I think April is the 4th best month. So November, and then so if you go into November, that's the best month. December, we usually get a Christmas rally, and then the yearly open, that's another great place for you to invest, because the yearly open, so hedge funds, they're trying to bring in their clients going into the new year. You don't want to be down, right? You don't want to be down the first quarter. As soon as somebody get into your hedge fund, right? You don't want to be down. So stocks usually go up, you know, for literally like the last 6 months of the year, from November to March, and then we have a pullback in March. Then that would be your next February, March. That'll be your next time to look to, you know, buy long term.
There was a good question I thought in the chat that was when you talk about look at futures first, how you do that.
So, waiting for the chart to switch over. There we go. All right, so I'm using Tradeview. So Tradeview, this is where I look at like the stocks that, like I got pretty much all my holdings here. I got Nvidia, Microsoft, Amazon, AMD, and Tesla. Those are the stocks that I'm in. Above that, it's called futures. So this is MES, right? So MES, that is the futures contract of the S&P 500. And just listen to the name, future. So these are traders betting on the future price of the asset. So they're basically like everybody in the futures market, they're all trading based on the idea of where they think the market is headed. That's why it's called futures, because they're betting on the future price of the market. So like sometimes I'll see like this. So you can see like 3 p.m., 7 p.m., 3 a.m. Like the market is going up. 5 a.m., 7 a.m. The market is going up. Like if we look at this run, let me look at regular candlesticks. So this candlestick is literally 9 p.m. The market is still going up. 11 p.m. Market is still going up. 1 a.m. market is still going up. So that tells me that the market is gonna probably go up when the market opens. But actually, you said what?
I said, oh, okay. I see what you're saying.
Yeah. So
like, just as a clarity, Monte, if you don't mind me asking.
Yes,
So
ma'am.
basically you're looking at the trend of what people are betting against or for.
Mm-hmm.
And then based on that, you can, I guess, draw the conclusion that if people are putting their money in there, then this is probably the direction that the market is going to go for this particular stock.
So with futures, you're saying like with just in general or with futures?
Yes, I'm talking about with futures. Are you looking at futures per stock, or are you looking at futures for the S&P 500 or an index?
Okay, so the futures that I look at MES, so that's S&P 500.
Okay.
I look at MNQ, that's NASDAQ. I look at ZB, that's the bond market, and then that's a hedge fund strategy. So when ES, when the S&P futures and the NASDAQ futures go up, usually ZB comes down. They're inverse of each other. So that's why you see, like when Trap was talking about, this was like a long time ago. He was talking about as soon as the bonds hit 2-year hits 4.5%, then stocks go down. So he used that as like a resistance point to know, okay, I know when stocks are going to come down, so I'm not going to do no plays. He talked about that like a long time ago. So it's the same thing with ZB, that's the bond market. I look at crude futures, so that's oil, and then I look at Bitcoin futures, and then I look at gold futures. So those are the 6 ones that I'm looking at. But they got all kind of, they got like corn, wheat, orange juice, cacao, like coconut futures. They got all type of futures. They got pork futures, they got beef futures. But these are just like the main things that we look at.
If those are
Good
futures,
question.
what are commodities?
That's a good question. I personally don't know the answer like the by the book answer, but I think commodities are more so like, I think like actual like physical things that you could trade off of, like things that you could eat, things that you could touch, things that you could like.
It's something that's supposed to be a necessity.
Gotcha.
Corn, wheat, oil,
Okay.
like pretty much everything
Yeah.
that we consume
Okay.
as far as food and other things comes from wheat and corn. Coffee, the things that like are almost pretty much a necessity in life is what they made as a commodity. So that's why they try to put Bitcoin as a commodity now, or whatever, because they want to call it security, but it's almost as a necessity as how, if you pretty much, that's the basic of it. I mean, there's more finer tuned answers to it, but the basis of a commodity is just pretty much necessities. And that's why you see oil, wheat, corn, gold, silver,
Okay. Got it.
And
Okay.
wait, let me
Thank you
ask you
so
this
much.
question because that piqued my thoughts. So, are they assuming that these heavy metals like gold and silver are commodities because they stabilize the monetary system, or because they are used as conductors?
both.
Okay. All right.
Both. Yeah. I mean, if you look, I mean, gold and metals are used in 99.9% of almost every type of electronic or
Right.
most like things that we consume with. I mean, and people don't even really realize how much of precious metals are in our day-to-day lives. We don't really actually realize that.
Well,
But
yeah, I mean, well, my background, so I realize it. I mean, because gold is the best conductor out there. It's just so expensive, and people will rob if they knew
yeah,
gold was a conductor. Yes, but yeah, I received my answer. Thank
yeah.
you.
Yep.
One quick question, just to
Yeah.
clarify. So when you are looking at
Thank you.
futures, are you on the site TradingView? Okay.
Mm-hmm. You can download the app on your phone, or you could just get on a computer and use
No,
it.
as you're talking about things, I'm opening them up on my other computer. So thank you.
For sure. Yes, ma'am. Yep. Just go to tradingview.com,
Got it.
and then I pay for like the $20 version. It just lets me add like more indicators on there.
Right.
Because like the moving averages, that's just like the base of what I use, like to start everything. But yeah, you can just use a free version and then just set up how you want to.
Okay. Thank you so much.
I got one, Monte, real quick. So
Yep.
how is this used versus us using like alligator, MACD, stuff like that? Is this just like a stronger tool than those options, or could we get the
As far
same?
as what moving averages?
Yeah. What
Okay, so
just what you're doing now? You call this trending, chart trending.
yeah. So okay,
You're very detailed with it.
I'll put it for sure. I'll put it this simple, right? So me, I read a lot of books, right? I'll tell y'all my personal story. So I dropped out of college to start doing this like on my own. When I was in finance, I went up to my teacher, who she actually worked at Morningstar, right? So all the the ratings that they give on stocks, that's where she used to work at. So I went up to her, I showed her everything I knew about stocks. And she told me, she was like, you know, you're really not gonna learn, you know, that much out of this school because, you know, pretty much what you already know, that's what we teach. Right. So anytime that I personally try to do something, I make sure that I have like the data behind it. So trend following. If you want to make money, I'll ask y'all a question. So y'all were, I was only 4 when 2008 happened, right? Wouldn't it be nice to make money in 2008 when the stock market is going down?
Mm-hmm.
Wouldn't it be nice to make money in 2000 with the dot-com bubble when the stock market is going down?
Yep.
Yeah. 1985 when you had, or what was that, 1987 when you had Black Monday? Wouldn't it be nice to make money when the market is going down?
Yep. Absolutely.
So just literally just follow the main direction that the market is going. I'm just following the main direction. That's all I'm doing. That's why it's so easy. Literally whatever, like if you look at this chart, what's the direction? Is it up or down?
It's trending
Looks
up.
like it's trending up.
Straight up. So that means all of my trades are going to be to the upside, right? And that's on the futures. So I can show you like Intel. I'm short Intel all the way down to like $3.
All the way down.
I'm short Intel all the way down to like $3, right? Is this stock going up or down?
Wow.
It's trending down.
It's going down. So how much money would you have made if you've been short from here and you just go all the way down, right?
Yeah.
I'm literally just, all I'm doing, I'm following the main direction of the market. I personally had to get better with entries, right? So if you just trade with the general direction of the market, it's like trying to swim against a current. Why would I swim against the current? These people have billions of dollars. Like they're trading billions of dollars every day. Like BlackRock and Vanguard, they got 11 and 15 trillion dollars. Like BlackRock, Vanguard, they hit a record of assets under management, like 15 trillion. They have so much money. I'm not nobody to them. When I take a trade, that's not moving the direction of the market. So I need to follow the big money. That's all I'm doing. So when the market is going up or a stock is generally going up, I'm trading it to the upside. When the stock is going down, I'm trading it to the downside. But like I said, technicals are just fundamentals on the screen. Intel, somebody explained to me how Intel is a chip maker or manufacturer, right? The biggest investment on earth right now is the chip market, and Intel stock is coming down.
Right.
So if their stock is in the best performance sector of this year and your stock is going down, that's another reason for me to be short this stock. They missed earnings the last 2 quarters. That's 2 reasons for me to be short. They're below almost all the moving averages. That's another reason for me to be short.
Right.
They said they're not going to have, the chips that they need to really make to compete with NVIDIA and AMD and Qualcomm until 2027. So I'm short for the next 2 years at least, man. It's just using all these factors and putting them together.
Yeah, that makes sense.
Try to make it I try to make everything simple, because investing is so easy to get, once somebody says one thing to you, that's why no matter what y'all say, I'm gonna keep doing my thing no matter what. But I want to try to do the exact same thing. Once you have something that works for you personally, because we're all not gonna trade and invest the same way. That's why I don't care what nobody uses. Moving averages, that's just what I personally use. Historically, I use it because historically it's been proven to be the best strategy. I'm trying to be the best of the best. I study Jim Simmons. Y'all probably don't even know who that is. He's a hedge fund manager. He's returned 60% for the last 20 years. No one has even heard of him. Jim Simmons, 60% return on average. He charges 44%. So he's making you 60%. He's charging you 44%. Warren Buffett has not done that. Paul Tudor Jones has not done that. So this is an investing mogul that no one has even really heard of, that everyone needs to be looking at him. He has the highest, I don't know how he's literally the highest. He's given the highest returns over the last 40 years, and no one knows about him. But that's because that's what he doesn't want to be known. He wants, like, his hedge fund. He doesn't invest money for other people. People come and work there, and they all invest money together. Like, there's no, he doesn't invest money for the everyday person. So with us, that's where I see us at, like, trappers, right? We're all smart. We all have different, capabilities. We're all good at, different things. We all came together. Like Trap, he wants to start a hedge fund. So why can't we be the individual, workers under him and make money together?
Absolutely.
I agree.
I like it.
That guy Jim, do you follow him? Did he write a book, or or have some type of podcast or something?
Jim Simmons?
Yeah.
You're not gonna find nothing. There's no book. It's one book. I looked it up. It's one book, but it's not. He didn't write it. There's somebody else wrote it about him. So Jim Simmons. So how he made money? He literally he uses mathematical probabilities. So that's why, like, my next step is like automation and trying to use mathematical probabilities. He makes money off of okay, he'll look at one stock, he'll look at, let's say, Apple, and then he'll look at Microsoft. Like, those stocks, they usually trend upward together, right? They move together. But he'll look at, let's say, Apple, and let's say a company like ExxonMobil, right? So that's gas and tech. So if tech is going up, then gas and oil is probably going down, and vice versa. So he'll be long, he'll go long Apple, ExxonMobil, short. And then once it reaches like a certain point, he basically measures like how close two stocks are far away from each other. So let's say, like, every day they're probably like $5 away from each other, right? So if it gets outside of that $5, then we're going to like crazy numbers. That's not really accurate. If the average is 5, I want to stay in between 5.
Yeah.
Does that make sense or no?
I figured if he said he doesn't really want to be known, he's quiet, that he probably doesn't have any. He's probably not like writing.
Well, they said he died in May.
Yeah.
Oh, he just passed.
Yeah, go RP to go.
Okay.
So Monte, I have a question.
Yes,
when
ma'am.
You're saying short, you're talking about betting against the stock, correct?
Yes, ma'am. Puts and short are the exact same thing.
Basically like a put.
Yes, ma'am. Same. It's the exact same thing.
Okay, so but when you do puts, because my experience with puts hasn't been the best. Do you have to watch them more?
Nope. So that's why I said, going back to your risk to reward ratio, you need to have a stop loss and you need to have a take profit. When you get to doing multiple contracts, then you can have multiple take profits. So like if you have multiple contracts, your first take profit needs to be whatever your stop loss is. That needs to be your first take profit. So let's say your stop loss. If your stop loss is, let's say, y'all doing far out. So let's say $500, right? That's the maximum amount that you're gonna lose. Like you need to know how much you're gonna lose before you even do a trade. That's gonna take all pressure off. I know each trade, okay, I'm gonna lose maximum $300, $200, $400, right? So that's the max that I know I'm gonna lose because I have a stop loss. If it hits that point, it's gonna take me out of the trade. And you need a take profit, right? So when you got multiple contracts, your stop loss is 500. Your first take profit needs to be at 500. Your second one needs to be at 1,000, and the one after that is 1,500, and the one after that is 2,000 on each individual contracts. So, like,
and wait a minute. Now, all of those are your stop losses, or are you just saying that your first stop loss is your first take profit?
I'll draw for you on the chart.
Okay.
So let's say in a perfect
currently
world,
have puts on this right now, right?
Say that one more time.
So you currently have puts on this right now, right?
Not yet. I'm not.
Not yet.
As soon as it comes, as soon as Intel either when it breaks this line, this orange line down here, or when it goes below all the moving averages like it did up here, then I'm gonna be short, whichever one comes first. And then I'll be short all the way down to $14.04. So even that, like this is if let's say I enter here, right? The price goes below all the moving averages here. Like it hits this trend line and then it comes down and it's below the 20-day moving average. If I go short from there all the way to my target, my risk to reward ratio is 16-1. So that's like making $16,000. I'm basically risking $1,000 to make 16, right? If I do that 4 times, I'm almost at what, 15, 30. I'm over 60,000.
I know you say risk reward, but just curious, why you know it's going down, why you not riding it down with puts versus
because
waiting on
the market, again, the market is all assets are created to go up. That's why when I short, I'm only shorted for 2 weeks max. You don't want to get caught. You don't want to get, like, you see reports about short sellers, how, they bet against Tesla stock.
Yep.
Yeah.
I never ever want to get caught in that, right? So again, if the market is designed, it's created literally. Like when rich people create something, they create something so they can make money off of it. They don't ever just do something and they're not gonna make money off of it. Like that's why you see all this money flowing into Bitcoin and crypto now, right? And they've been quiet about it. Intel, yes, it's a bad company. That's just what it is, right? But the market, like Intel, it could be earnings and then the stock could go up, right? Or it could have some news that come out and then the stock goes up, right? The stock is meant to go up. If they had good management and they innovated and they, instead of lollygagging, they acquired AMD and what's that company? Supermicro, right? Intel was making $50 billion at one point and they didn't acquire AMD and NVIDIA when they were small. That's their fault. If they did that, then the stock would be up. So just as fast as the stock could be up if they did those things, the stock could go up over some news or something else, right? But again, the market, it only goes down like 25% of the time. So why would I be short for a year? That's just me personally. When I'm short and I want to short, make my money, and then leave. If the opportunity comes again, short, make my money, then leave. Like Intel, literally this whole time. Short, make my money, leave. Same thing down here. Short, make my money, then leave.
So now I understand, Monte. What you're saying, you go in with a plan for the short.
Every time.
Then once it reaches that on your chart or approaches that, unless something drastic happens, you're pretty much automated at that point. You can exit the play.
Right. Everything I do,
I got you.
I'm automated. I'm just doing it. That's what I'm trying to build like machine learning and a code thing to do it for me. Everything that I'm doing, I have to operate like I'm a machine. I'm a human, right? We're all human. We have natural errors in what we do. Right. I'm emotional just like you, right? I go through stuff just like you, right? I might have a bad day. I might have, something going on that can affect me emotionally. That's going to affect my investing and trading. So I always have a plan. Like Intel, I've been looking at Intel for about 2 weeks. I've been looking at AVGO for about 2 weeks. I've been looking at TSM for about a month. I had a setup there, but it didn't do exactly what my setup does. Like if it does not do exactly what my setup does, then I'm not taking it.
Okay.
90% of trading is being patient and not doing nothing. Like would you rather wait? Like that's like touching the stove when you were a kid. Your mom keep telling you, like at what point are we not gonna touch the stove? If I keep changing my strategy or I keep entering too early, right? That's error. That's human error. When I stick to my strategy, I can actually go and find out what's wrong with it. If I keep doing different stuff, I can't figure out what's wrong with it.
Correct. And I like that because as I was listening to you, what ran through my mind is when you start trading, or I guess on the option side, and you I guess win more than you lose overall, then it becomes addictive, and that money seems to burn in your pocket, because you think about money that's sitting idle, is not moving, you're not making any money, you're losing. But from what I hear from you, it's not that your money is being lost. Your money is sitting for the right opportunity so that you can strategically move and not lose as much. Is that? And thus that's what a hedge fund does, because they don't move by emotion, they move strategically. And so I like what I'm hearing, and I'm just trying to process it and then think about my own error, because my money burns my pocket and I want to go make more, but sometimes we're on the downside of something because we didn't move strategically, or we listened to other people and we jumped into something and we weren't solid on the plan within ourselves. So
That's why, like, yes, ma'am. Thank you as well. Like, the one thing I want everybody I want to emphasize, one, like, you have to have a plan. No matter what, you have to have a plan going into whatever you're doing. Like, you have to move like a hedge fund. If you're not moving like a hedge fund, or you're not moving systematically, then you are setting yourself up for failure. Even if you're winning, you're gonna, okay, the market is going up. Now, when the market changes, in the market, we're in a bear market and we're down 20%, or we're in the market where, we're only up 3% of the year, then what are you gonna do? Right? Then how does your strategy work? Then how does your thinking work? Right? When things change, then how do you perform? That's why you need a system. You need to do the same thing no matter what. You need to do one thing that works no matter what environment you're in. Like for basketball, Curry is always going to shoot a three. That's what he does, no matter what. In the game, he's going to shoot a three. He's going to shoot 7+ threes a game. That's what he does. That's what works for him. LeBron, he's gonna drive and he's gonna get to a layup. He's gonna post you up and he's gonna do a fadeaway. Those are two things that he does that work for him. So you have to look at yourself like an athlete. Like when I'm looking at the market and I'm trying to make money, I'm looking at, okay, investing long term, that's one way to make money. Trading, that's another way to make money. And then automation, that's the third way to make money. And then you get into high frequency trading, that's the fourth way to make money, but that's not what I do. But if you don't have a plan, you're going to fail. One, if you don't have a system, you're going to fail. If you don't follow the system, then you're going to fail. That's why I keep saying, like, you can be a losing trader and make money. You can win 30% of your trades. If your risk is correct, then and you win more money than you're losing, you can still be profitable. So your win percent does not matter.
I sure appreciate that.